Welcome back to the Genius Maltby channel. Good morning, good afternoon, good evening, wherever you are on the planet. We're going to take a look at a conversation regarding Gresham's Law, kind of review it. We've discussed it in the past regarding pennies, regarding nickels, regarding money in general. And a subscriber brought up a really good point in the comments the other day, and I wanted to touch on it, kind of broadcast it to the entire audience and see what everyone's thoughts were on the point he brought up. So we'll get into it. We'll talk about Gresham's Law. We're also going to look at some new and additional predictions as to where the metals are headed for 2018. I've warned you guys before in the last several videos. As you get close to the new year, you start seeing all of the prognostications of where markets are going to go, where metals are going to go. And I got a couple points that I wanted to piggyback onto the Gresham's Law conversation as well. Kind of take it off in a different direction. Maybe invent up our new economic law. We could call it something else. I don't know. We could call it the Satoshi Law or something. But I want to make a comparison to Gresham's Law and what's taking place in the currency world, in the world of money as we know it, between what we see now as cryptocurrencies and fiat currencies, and where the ebb and flow is, why one might be flowing into the other. So on that note, let's move on and get a foundation of what we're discussing with Gresham's Law, kind of look at the definition of it. In economics, Gresham's Law is a monetary principle stating that bad money drives out good. For example, if there are two forms of commodity money in circulation, which are accepted by law as having similar face value, the more valuable commodity will disappear from circulation. Real good example, and it's going to be brought up while we discuss this, silver in circulation. You don't see any silver coins in circulation anymore because their intrinsic commodity value exceeds their face value, so they are hoarded out of circulation. Same thing's happening with these over here. Oh, they're jingling already. They're jingling. Those are my pre-1982 pennies, all of which are 95% copper. And those are also disappearing. Did I drop one? No, I did not drop a penny. I don't want to drop those coppers. They are also being hoarded out of circulation because of the commodity value. They're worth 200% more than their face value. They're worth like 2.2 cents. They're a better form of money. They hold their value. They go up with the price of copper. Why would anyone spend them on groceries or bubble gum when they are worth more than the government fiat declared value? What is the Gresham's Law? Gresham's Law is a monetary principle stating, again, like we just said, that bad money drives out good in currency valuation. Gresham's Law states that if a new coin, bad money, is assigned the same face value as an older coin containing a higher amount of precious metal, good money, then the new coin will be used in circulation, while the old coin will be hoarded and will disappear from circulation. Breaking down Gresham's Law. Coins were first made with gold, silver, and other precious metals, which gave them their value. Over time, the amount of precious metals used to make the coin decreased because the metals were worth more on their own than when minted into the coin itself. Of course, kings and empires, authorities, governments would water down the metal in coinage on purpose, be it to increase their coinage in circulation, increase their own wealth. Just look at British coinage. We've touched on British coinage here in the past, and we've looked at the 1919 coins that the silver contents were reduced, and then we've looked at the pre-1919 coins where the silver was the highest content silver standard of any coins at that time in the world. It even exceeded the purity of U.S. silver coinage. The British coinage, the sterling, was 92.5% silver, whereas the U.S. was 90%. The U.S. reduced its silver completely out of its coinage in 1965. The pre-64 coins were silver, and then everything after that, other than some of the half dollars, as you all know, I don't want to get into the details on that, but some of them floated around at later years with 40% silver. However, that's a sign there, and that is Gresham's Law. All of those coins slowly but surely some of them actually quickly were hoarded out of circulation. Let's continue though. If the value of the metal in the old coins was higher than the coin's face value, people would melt the coins down and sell the metal. And that's not always true. A lot of people would keep the coins just as the coins themselves because you know the specific weight and purity of them, because they were a minted coin at one time and there's no reason to have to assay it. You could just look at the coin and go, oh, that's a 1964 quarter. It holds such and such amount of silver. It weighs this much at this value today. Similarly, if a low quality good is passed off as a high quality good, then the market will drive down prices because consumers won't be able to determine the good's real value. And here's another piece on Gresham's Law. We'll skip ahead because the first paragraph covers mostly what we just talked about. I want to get into where it comes from. Sir Thomas Gresham, financial agent of Queen Elizabeth I, was not the first to recognize this monetary principle, but his elucidation of it in 1558 prompted the economist H.D. MacLeod to suggest the term Gresham's Law in the 19th century. Money functions in ways other than as a domestic medium of exchange. It also may be used for foreign exchange as a commodity or as a store of value. If a particular kind of money is worth more in one of these other functions, it will be used in foreign exchange or will be hoarded rather than used for domestic transactions. For example, during the period from 1792 to 1834, the United States maintained an exchange ratio between silver and gold of 15:1, while ratios in Europe ranged from 15.5:1 to 16.06:1. This made it profitable for owners of gold to sell their gold in the European market and take their silver to the United States Mint. The effect was that gold was withdrawn from domestic American circulation. The inferior money had driven it out. So bear with me here as we move forward in this discussion. We saw how coins of a higher purity and what would be viewed as a higher value end up being hoarded, while the lesser valuable coins are used within transactions and such. We also saw how discrepancies, or you could also call it, I guess, arbitrage, between different valuations of precious metal coins. We saw gold being sold in Europe and those individuals coming back to the United States with more silver and then being able to exchange it for a bigger position in gold and continuing doing that, always arriving at having more gold, a larger and larger gold position every time they sold gold in Europe, bring the silver back, exchange that silver at the ratio here for gold, and then take that gold back, and every time, again, increasing their foothold, increasing their position and how much gold they held. Now, the reason I bring this up, and we talk about Gresham's Law and this, also the way that the arbitrage with gold and silver were working that was in that last article where Gresham's Law was also discussed, is in a comment. Just one comment set this off, and I can't find it. I wish I could. I know it's somewhere buried in one of the last videos from this week. The individual mentioned, what about Gresham's Law being applied to cryptocurrencies? Obviously, they didn't exist, but Gresham's Law is a human event. Economics is the study of how humans move goods and services and money, the economy, how we interact with it. Gresham's Law is part of that. It has a lot to do with how humans value things and how we transact with these different mediums of exchange. So if cryptocurrencies occupy that role in a way, which they are slowly finding a way that they occupy at this point about a $450 billion market cap, or 500, whatever it is today. Is there a chance that some of these cryptocurrencies will suffer from basically a digital or a crypto Gresham's Law? Now bear with me, think about it. What if some of these coins, as the free market hashes it out and as humans interact with them and say, oh, well, I like this one, I don't like that one, this one's easier to use, this one's faster, this one's cheaper to use, this particular coin has more logistical support, it's more stable in value, it's resisted this, it's resisted that, Who knows? As those decisions are hashed out and people observe things and make a decision on which cryptos they're going to use, this is a global decision at this point, some of these will most likely fall away. Now, it's not exactly a Gresham's law, yes, but I'm going to use some examples here that might not be entirely accurate. So when I say, if I use Bitcoin for an example, I'm not guaranteeing or saying that I believe this about it or that, or this is my future predictions for it. Pretend for a minute Bitcoin becomes what some people believe it is, and it is the digital gold. It's worth, let's just put a number out there, it's $50,000, and it stays at that forever. It's very stable, and maybe it goes up like 2 or 3% a year. It just kind of hangs out there, very stable. And it's a good store value. It has a lot of support. It's the original one, so it's everywhere. It's very easy to use. There's a lot of support network for it. It's being traded here and there. There's a good chance that due to that, some people might hoard it, and if the value is going up at a really respectable rate, let's say, again, let's go back to maybe 5%. It's going up 5% all the time. And people would be more prone to, let's say, pretend to hold it and not spend it in transactions. Whereas some of the cheaper, maybe less valuable coins that are fast, easy to use, maybe even more volatile, some of those might be losing value over time because there's so many of them. Again, this is kind of a foggy gray area to apply this rule to crypto, but it is an interesting point that a subscriber brought up. Is there a chance some people will hoard some of these cryptos away, kind of remove them from the market, not really use them a whole lot, and then other ones will just be spent as soon as they're brought in, or not only just spent, but locked away in another coin that is more stable or of a better value? For example, let's pretend we'll just make up a coin here. We'll call it LLL, coin LLL. It's not very good. It's new. It's pretty volatile. Maybe for some reason you've come to acquire them and you want to get rid of them as quickly as possible because you just don't trust it. It's a new coin. Maybe that's all somebody had to pay you for some goods and services, and you did accept it. You immediately go to an exchange and you sell them or lock them up, trade them away in order to acquire Bitcoin with it, or Ripple with it, or Litecoin, or Ethereum, something else. You try to get out of that new coin for one of those guys instead. That could be a likely scenario. So we just looked at how Gresham's law could maybe find its way into some little digital Satoshi's law in how cryptocurrencies are exchanged with one another and which ones people actually decide to use or not. Another thing is the relationship that it has with fiat paper currency. Is there a good versus bad money here? Are they, quote, circulating alongside one another? Even though they're from different entities, one's issued by the will of the state and has a $68 trillion market cap. It could be inflated indefinitely. It loses 3% of its value a year. We're speaking about the US dollar. Or is it a fixed supply digital code that doesn't suffer from those inflationary moves, doesn't have the oversight of a centralized governing authority, and is more used globally, and that it being on the crypto side? Is there a chance that one of these could drive out the other? For example, could people be spending their dollars as fast as they get them, locking them up in crypto to get rid of the depreciating value of their dollars, spending them, and then hoarding away or holding the crypto, hoarding it off the market? Does that make sense? Kind of a Gresham's law applied between these two competing currencies. We'll go through a couple articles here, so I just want you to keep that part in the back of your head. That's why I put that first slide up about inflation, the large rat eating currency. We all hate the dollar. If you're part of this channel, you know the dollar's garbage. You know it's a rotting leper currency. It's inflated, it's issued by debt, it's used to fund war and a lot of atrocities. It's not a good thing, the United States dollar. It's a bad thing. It represents a lot of bad. And it's used by a lot of bad people. It's what gives the statists their authority in a large way. their ability to have this reserve currency that controls the whole world, the almighty dollar. And I kind of like seeing it get threatened a little bit here. So let's look at some of these next articles, and I want you to think about, where the dollar's going. We talked about it this week, down 0.69%, pretty huge drop in a single day. We looked at the overall trajectory going into 2018. Doesn't look good. Doesn't look good at all. Is there a flight? Is there a movement? Is there an exodus of people leaving their positions in the US dollar? As Warren Buffett said once before, the worst asset you can hold, I believe I don't know the exact quote, but basically he alluded to the worst thing you can do is hold US dollars. Of all the things you can do with your money, the worst thing you can do is have a large exposure to US dollars, because they're losing money, losing value, I should say, all the time through inflation. Now this is where the most boring channel on YouTube gets very boring. We're going to read now the glaring differences between electronic fiat and cryptocurrencies. I've got several different clips here that I want to go through and just think about what we just talked about. There are significant differences between the traditional digital currency in your bank account and cryptocurrencies like Bitcoin. One of the biggest contrasts between the two is Bitcoin's deflationary attributes, which is backed by the currency's 21 million capped supply. Many economists believe this is a great benefit, as the public knows that there are only so many Bitcoins, which causes people to save, and purchasing power usually increases. With traditional digital fiat reserves, there is no telling how much money is circulating, and no one knows if the central banks are printing money on a whim. Economists who are against this type of monetary practice, such as those from the Austrian school, believe the world's citizens are experiencing a silent robbery called inflation due to central planners printing vast amounts of fiat reserves. Sometimes, central banks like the Federal Reserve tell the public they are creating more money with concepts like quantitative easing and the recent bank bailouts. Remember, this is the environment in which Bitcoin was born. That's one of the theories behind the driving factor on why it was born to begin with and what motivated those that released it. Now, this isn't me being some super advocate here, guys. I'm just reading some information and trying to take an objective look at whether or not Gresham's law could theoretically apply and how currency competition could potentially drive one of the two off of the market. This isn't a for or against video. This is a look at how economics works, different economic theories, and how it could affect competing currencies such as fiat versus crypto. Here's another clip, the downfall of centralized currency. One of the most often heard comments is how fiat currency can be printed on demand. While most people think this statement is overrated, every governing body around the world can create additional fiat currency, quote, out of thin air, unquote. It goes without saying that by increasing the total supply of fiat backed by the previous value, all money in circulation becomes less valuable. There's multiple videos on this channel where we've covered hyperinflation, inflation. We've looked at Zimbabwe, Weimar Germany. We've looked at what took place in Venezuela. We've looked all over the world and seen how many currencies have gone extinct or expired or been inflated to death. So this should be not a surprise or any news to anyone that this happens with fiat, paper, leper currency, garbage. Speaking of fiat currency being backed by assets to create the illusion of value, the US dollar has not been tied to a tangible asset for quite some time. In fact, every US dollar in circulation is backed only by the full faith and credit of the United States. And I don't have any faith in the United States, and I don't believe they have any credit left. And it has no inherent or intrinsic value whatsoever. It's a piece of silk and cotton, ladies and gentlemen, with ink on it and a picture of a dead person. Furthermore, once new money has been generated out of thin air, with no value to it whatsoever, the U.S. Treasury distributes all of the additional funds to one of 12 Federal Reserve banks. It is important to note there are two privately owned Federal Reserve banks creating a non-transparent ecosystem in which a handful of people determines the wealth of an entire nation. Ladies and gentlemen, if you have a problem, and this is one of the, again, eye-opening light bulb moments for me, I did have a problem, and I still have questions and still remain skeptical and critical about cryptocurrency. But if one of your critiques is that it is, quote, not backed by anything, then I would like to ask what you're doing with a bank account full of dollars or a wallet full of cash, because they are also not backed by anything. And when compared side by side, I would say are less backed and less valuable when it comes to how they function, their faith and their credit. Again, you have to look at the centralized authority that controls the fiat versus the people or the large ecosystem of individuals, the common person who might have these, I guess, digital wallets with these cryptocurrencies in them. I do believe that environment, or the role that crypto has taken in a sense, is threatening this full faith and credit of the United States. It's threatening these fiat dollars. I sent a video out the other evening of Ron Paul discussing cryptocurrencies, and he was sharing some of his excitement and what he has been viewing. And that's a pretty staunch, sound money, free market, libertarian guy that I respect. And I did send the video out to the subscribers here. And the question I have at this point in our timeline is, where does this end up? Does somehow a crypto come along, or has it already arrived, that might dramatically threaten and drive so much fiat out of the marketplace, or disrupt or destroy the fiat economy, that something takes place? Maybe some kind of a shift, some kind of liberating event. I don't know. But I do think this is a valid assessment, and it's definitely a part of this puzzle that we can all look at. And we can all agree that there is something taking place. And perhaps it challenges our own observations as well as our perceptions of this topic. Real quick, the gold and silver news is just around the corner, but this piggybacks on what we were just talking about. Perhaps this is why these traders are making some of the bets that they are. A trader makes $1 million bet that Bitcoin will triple next year. Online records from New York-based digital currency trading platform LedgerX showed 275 call options expiring December 28, 2018 were bought in Wednesday's trading session. The options were bought at a volume weighted average price of $3,600, meaning roughly $1 million was spent on that bet. With Bitcoin trading near $16,700 Thursday, that means the trader or traders expect the digital currency to soar more than 200% in the coming 12 months. Second paragraph here. The trade gives the investor or investors the option to buy Bitcoin at $50,000 in the roughly next 12 months, implying expectations that the digital currency will soar beyond that price. An investor would lose the bet if Bitcoin doesn't reach $50,000 in that time period, but would reap profits if it climbs well above that level. So to recap, someone just bet Bitcoin will top $50,000 next year, and they bet $1 million that it will happen. Yesterday we saw a little rise in gold, a little bump, a little retreat today. It's down from yesterday's high, but gold ends higher as lawmakers send tax package to Trump. Weaker dollar clears way for gold gains. Yes, the leopard dollar. It's weak, always weakening. First paragraph here, it says gold ended with a modest gain Wednesday, notching its fifth daily rise in 6 sessions, with dollar softening as lawmakers approved a sweeping tax overhaul. The yellow metal climbed as stocks struggled for direction following a series of records in anticipation of the passage of the bill, which includes massive corporate tax cuts. Last paragraph, gold has been on the rise since putting in its settlement low of the month on December 12th at $1,241.70, helped by a weakening dollar that makes gold cheaper for holders of other currencies. Gold is up over 10% for the year, a gain largely accumulated by the precious metals surge in the early months. In fact, data shows that prices have been confined to their narrowest trading range of any quarter in a decade in the last 3 months of 2017. That should put up a flag for every single one of you that knows charts, knows gold, knows history, economics, what's going on with the currencies, what we looked at with the dollar recently. That narrowing trading range, what some are calling a bull flag on gold, is very promising for a rise in gold. We've seen predictions of $1,700. I don't put my name on any of them. I'm just giving you guys information and news, passing it on, letting you make your own big boy decisions when you pull your big boy pants on. So don't take this as advice, but it looks like gold could make a very positive move here in the future if you're looking for a stable, safe haven asset. Let's look at some of the predictions that are coming down through the pike as we go on here and read them. Gold expected to average 1,280 an ounce in 2018. Silver at $17.78 an ounce. So the numbers are a little different from some of the previous statements we've seen. Obviously, 1,280 is a lot lower than 1,700. Gold prices will average $1,280 an ounce in 2018, with buying interest as an inflation hedge and due to loose monetary policy globally, offset by a strong U.S. dollar, said BMO Capital Markets in a research note. I would like to know who did the research for them and told them that there was going to be a strong U.S. dollar, because we saw the report by Deutsche Bank that we'd see unexpected inflation in the ending quarters of 2018. So again, you get 4 economists in a room, you'll get 15 different opinions. None of these guys can figure it out. And they say it's not exact science, obviously. It's not even a science. It's all theory. It's a bunch of gobbledygook. All of it. Nobody knows. You could stop a random transient on the street, a homeless man who lives in a cardboard box in an alley, and he could probably predict things just as accurately as these economists. A slow and steady interest rate hike cycle proposed by the Federal Reserve and subdued investor demand are expected to keep prices in check and cap any significant upside potential, the bank said. Analysts describe the metal as remarkably stable over the last 2 years compared to the broader commodity complex, saying gold prices were range-bound during normalization of monetary policy, and as dissipating geopolitical risks meant less safe haven interest, this was offset by building inflationary pressures, which meant some market participants are looking to increase their allocation to gold as a hedge. We see benefit coming from still loose monetary policy and renewed inflation concerns, but potential for headwinds from dollar strength, BMO said. I would not worry about those headwinds. Macroeconomic data point to a strong U.S. economy with the labor market nearing full employment. BMO said U.S. inflation is forecast to slowly move toward the long-term target of 2%. BMO continued, the market anticipates at least 2 more Federal Reserve rate hikes in 2018 in the wake of another 25 basis point tightening in December. BMO looks for the gold-silver ratio to fall from around 79 as of mid-December to roughly 72. This ratio measures the number of silver ounces it takes to buy 1 ounce of gold, with a smaller number meaning an outperformance by silver. Recovering industrial demand is expected to see the gold-silver ratio mean revert over time, and while price forecasts were reduced, we expect the metal to relatively outperform gold over the coming years, BMO said. In particular, photovoltaic silver demand for solar panels is recovering, BMO said. The bank said it also looks for jewelry and silverware demand to contribute to a resilient market outlook for silver. Meanwhile, BMO is forecasting that silver prices will average $17.78 in 2018 and $17.90 in 2019, so it doesn't look like they're predicting it going above $18 for about 2 years here. Analysts suggested silver could play catch-up to gold, especially with industrial momentum leaving much of the market focus on base metals. Gold, silver, likely to disappoint investors in 2018. After a strong year, precious metals will start the new year with lots of headwinds ahead. Looking to 2018, ABN AMRO expects precious metals prices to disappoint, said Georgette Bull, ABN AMRO's precious metals senior analyst, in a report. The Dutch bank said that higher U.S. dollar and U.S. Treasury yields will put downward pressure on gold and silver prices in 2018. For example, gold is estimated to trade between $1,200 and $1,250 per ounce next year. ABN AMRO also pointed out the Fed will likely raise its key policy rate at least twice by 25 basis points in 2018, which will significantly weigh on the precious metals prices. Dow retreats from records, snaps 5-day advance. Walt Disney to buy 21st Century Fox in a $52.4 billion deal. U.S. stock market indexes relinquished earlier gains, finishing lower on Thursday with the selling pressure coming from healthcare, material sectors, and telecoms sectors. A Dow crash, another 25% jump. No, here's the case for a market freeze in 2018. Yes, the shortest day of the year is here, and I want to skip to the bottom though. Plenty of traders will be cutting out in any case. With the holiday weekend creeping closer, they might want to consider sitting out all of next year, according to our call of the day, which comes from technical analyst Chris Kimball. He says, as the Dow is quickly approaching the 25,000 level, some might find it hard to remember that in the very near past, the Dow traded sideways for 21 months. The Kimball Charting Solutions founder writes, the blue chip barometer, which has climbed 25% this year, now could show flattish action for 21 months again, he suggests. Well, we don't need flat stocks because I've got gold. I'm not going to go into the Dow. It doesn't even matter what the Dow does. Here's gold today. It was up at 1270.50 earlier, which is surprising. I took a peek at it and was actually up 90 cents, up 0.07%. Silver leads again the precious metals barometer. Summary, the most speculative precious metal. Silver led gold lower. Silver, a technician's nightmare. Sell the rumor by the fact. Silver does the unexpected, which could be good news for bulls in 2018. We're going to start up here on the second paragraph. Silver is a magical metal that has made fortunes for some and sent others from riches to rags over centuries. Just ask the Hunt brothers, who made a small fortune in the silver market in the early 1980s from a large one. Silver is cheap compared to platinum and gold when it comes to its nominal price, considering that one can own an ounce of the metal for around $16.27, compared to $921 for platinum and over $1,270 for gold. Silver has played a role as the poor precious metal. However, when it comes to leverage, silver offers the best opportunity to make a killing, as it tends to move the most on a percentage basis. Every potential reward in markets comes with risk, and silver has always been a highly risky proposition. The most speculative precious metal, silver can sit for long periods and trade within a narrowing range. Silver is like a rubber band. The more you pull and stretch, the more it hurts when it eventually snaps. However, when this metal gets going, on the up or downside, few other commodities compete with the price volatility and trajectory of a move in the silver futures market. In the 1970s through 1980, the price of silver moved from under $1.40 to over $50 per ounce. In 2001, the price was trading at close to the $4 level. In 2011, it rose to $49.82 per ounce. When silver gets going on the upside, few assets can compare, sans digital currencies and perhaps natural gas. On the downside, silver can be a beast. In 1980, it fell from over $50 to just over $10 over a few short months. In 2011, it took the elevator shaft lower after reaching a peak. And that's one piece of advice that I do give to friends of mine who are heavy, heavy, heavy in silver. Right now, we have that ratio 78, 77, 79 to 1 with gold. That being 79 ounces or 78 ounces of silver to 1 ounce of gold. When that starts to narrow and speed up and get closer, I really do believe a lot of you should evaluate your silver positions, look at that ratio, keep a close eye on it. And when it gets close to 40 to 1, 38 to 1, maybe take a large portion or a percentage of your silver and transition it into gold. It's a smaller package. It ends up being lighter. You don't have to carry around, 79 ounces. You get to carry around the 1. If it gets down to 40 to 1, again, and then you get to reduce that 40 ounces of silver to the 1 ounce of gold, it can be a good move. I've done it. It pays off. It doesn't happen very often. And the next time it happens could be 2 to 5 to 10 years down the road. Who knows? But just keep your eye on it. As the author of this article states, when it does move, it moves quickly, and then it corrects quickly. So pay attention and always have both. But if you don't have any gold, use that as an opportunity to position yourself and lock in some of those gains from a tremendous bull run and rally in silver. And we've got another prediction for gold for next year. Gold to see $1,400 in 2018 as it recovers from the bear market. That's from ABC Bullion. So now we've seen $1,700, we've seen $1,280, we've seen $1,400. We've seen prices all over the spectrum. So it's safe to say it's anywhere from $1,270, $1,280, all the way up to $1,700 are the predictions for gold next year. That will conclude today's broadcast and topics and news and look at metals and crypto. I appreciate each and every one of you who's part of this channel. Thank you all for being here, for commenting down in the comments, for liking, sharing, subscribing. If you get a chance, I know some of you have been inquiring recently about the new channel gold coin that's coming out. It is, again, $15.22 over spot. There's a limited mintage of 400, and they are over at QSB, Quality Silver Bullion, being struck by the Regency Mint. Go over there, check it out. I'll throw a link down below if you are interested in that coin. It's going to be beautiful. It's going to be very well struck, and I'm very excited to see that 4.9 piece of quarter ounce gold. Thanks for being part of the Junius Maltby channel. All of you out there, have a good day.